The engine of the economy. What do banks actually do? What comes to mind when you think of a bank? Is it a place where your money is kept safe, or perhaps a place where you can get financial advice? Is it a towering building with vaulted ceilings, exuding an air of stability and trust? Perhaps it's the anxiety of applying for a loan, wondering if you'll be approved, or the satisfaction of watching your savings grow, however slowly, as you plan for the future. Whatever your perception, one thing is clear: banks play a vital role in our daily lives. They are more than just buildings, they are institutions that support our financial well-being. But what exactly do they do? What happens behind those counters and computer screens? At their core, banks are intermediaries between savers and borrowers. They act as a bridge, connecting those who have excess funds with those who need capital to grow and invest. They take deposits from individuals and businesses that have excess funds, and they use those deposits to make loans to those who need capital. This process is fundamental to the functioning of our economy. This simple act of intermediation is the lifeblood of any modern economy. It enables businesses to expand, create jobs, and drive innovation. It allows businesses to invest in new projects, individuals to purchase homes and cars, and governments to finance public projects like schools, roads, and hospitals. But the role of banks goes far beyond this basic function. They are multifaceted institutions that offer a wide range of services. Banks are also responsible for facilitating payments, managing risk, and providing a wide range of financial services that underpin our economic system. They offer checking and savings accounts, credit and debit cards, mortgages, and investment products. They are the gears that keep the wheels of commerce turning, and their stability is crucial for overall economic health. Without banks, the flow of money would be disrupted, affecting every aspect of our lives. So the next time you step into a bank, or even just interact with your money digitally, remember that you are engaging with a complex and essential part of our economic system. Take a moment to appreciate the complex machinery at work. From the tellers who assist you in person, to the sophisticated algorithms that manage your online transactions, every part of the banking system is designed to serve you. Understanding how banks operate is essential for navigating our financial world and making informed decisions about our economic future. By knowing the services they offer and the roles they play, you can better manage your finances and plan for a secure future. Financial literacy is key, and banks often provide resources to help you learn. Whether it's through workshops, online tools, or one-on-one consultations, take advantage of these opportunities to enhance your financial knowledge. In conclusion, banks are not just places to store money. They are dynamic institutions that support economic growth, provide essential services, and help individuals achieve their financial goals. So, the next time you think of a bank, remember the vital role it plays in our economy and in your personal financial journey. From barter to Bitcoin, a history of money and banking. The journey of money and banking is a tale of human ingenuity and the relentless pursuit of efficiency and security in trade and commerce. The concept of banking may seem like a modern invention, but its roots run deep into human history. From the earliest days of civilization, humans have sought ways to store and exchange value. Long before paper money and digital transactions, our ancestors engaged in barter systems, trading goods and services directly. This system, while functional, had its limitations. Imagine having to trade a cow for a new plow. Talk about inconvenient. The barter system required a double coincidence of wants, meaning both parties had to have what the other wanted. As civilizations developed, the need for a more efficient medium of exchange became apparent. This led to the creation of money, which could be used universally within a community. Enter money. First in the form of standardized commodities like gold and silver, which were valued for their rarity and durability. These metals were universally accepted and could be divided into smaller units, then evolving into paper currency backed by these precious metals. This innovation allowed for easier transport and storage of wealth, facilitating larger and more complex transactions. These early forms of money paved the way for the first proto-banks institutions that held deposits of valuables and facilitated transactions. These banks provided a safe place to store wealth and a means to transfer it over distances. The invention of the printing press revolutionized banking, allowing for mass production of paper money and the development of more sophisticated financial instruments. This made money more accessible and standardized. Banks began to play a more central role in economic activity, financing trade routes, and even funding wars. They became the backbone of economic growth and development, providing the capital needed for expansion and innovation. The 20th century saw the rise of central banking, with institutions like the Federal Reserve in the United States assuming the role of managing the money supply and ensuring financial stability. Central banks became the guardians of national economies, using monetary policy to control inflation and stabilize currencies. And now, in the 21st century, we are witnessing another dramatic shift with the advent of digital banking and the rise of cryptocurrencies. These innovations are transforming the way we think about money and banking, offering new possibilities for financial inclusion and efficiency. From barter to Bitcoin, the evolution of money and banking has been a long and fascinating journey. Each stage of this journey has brought new challenges and opportunities, shaping the world we live in today. And as technology continues to advance at an unprecedented pace, one thing is certain: the future of finance promises to be just as dynamic and transformative. The innovations we see today are just the beginning, and the next chapter in the history of money and banking is yet to be written. The money multiplier: how banks create money from deposits. This concept is fundamental to understanding the modern banking system and how it impacts the economy. It may seem like magic, but banks have the extraordinary ability to create money. This process is not about conjuring money out of thin air, but rather leveraging existing deposits to generate new funds. This isn't about printing bills in some secret basement vault. It's about a process called fractional-reserve banking. This system allows banks to lend out a portion of the deposits they receive, thereby creating new money in the economy. It's the foundation of our modern financial system. Here's how it works. When you deposit money into a bank, it doesn't just sit there idly. Instead, it becomes part of a larger mechanism that supports economic growth and stability. When you deposit money into a bank, it doesn't just sit there idly. The bank uses these deposits to provide loans to other customers, which in turn stimulates economic activity. The bank is required to keep a fraction of that deposit as reserves, a safeguard mandated by the central bank. This reserve requirement ensures that banks have enough funds to meet withdrawal demands. However, the remaining portion can be loaned out to other customers. This lending process is what allows banks to create new money and support various economic activities. Let's say you deposit $1,000 and the reserve requirement is 10%. This means the bank must keep $100 in reserve and can lend out the remaining $900. The bank keeps $100 in reserve and lends out $900 to someone seeking a loan, perhaps to start a business. This loan then becomes a new deposit in the banking system. That borrower then uses the $900 to make purchases, and the money eventually ends up deposited back into the banking system. This cycle of deposits and loans continues, creating a ripple effect throughout the economy. Now, another bank has $900 in new deposits. This bank can also lend out a portion of these deposits, further increasing the money supply. They too keep 10% in reserve, that's $90, and loan out the rest, $810. This process of lending and redepositing continues, amplifying the initial deposit through the banking system. This cycle repeats, with each loan creating new deposits, and therefore more loans. The continuous flow of money through deposits and loans is what drives the money multiplier effect. This is the essence of the money multiplier effect. It shows how a single deposit can lead to a much larger increase in the total money supply, thanks to the lending activities of banks. The money multiplier demonstrates how banks, through the simple act of lending, inject liquidity into the economy, fueling investment and economic activity. This process is crucial for economic growth and development. Of course, this process isn't without its risks, which is why central banks play a crucial role in regulating banks and managing the money supply. They ensure that banks operate within safe limits and maintain the stability of the financial system. Central banks set reserve requirements and other regulations to prevent excessive risk-taking by banks. They also monitor economic indicators to adjust monetary policy as needed, ensuring a balanced and stable economy. In summary, the money multiplier effect is a powerful mechanism that allows banks to create money from deposits. By lending out a portion of the deposits they receive, banks can significantly increase the money supply and support economic growth. However, this process must be carefully regulated to maintain financial stability and prevent economic crises. Understanding how banks create money from deposits helps us appreciate the intricate workings of our financial system and the importance of sound regulatory practices. It highlights the delicate balance between fostering economic growth and ensuring financial stability. The next time you deposit money into your bank account, remember that you are contributing to a complex and dynamic system that plays a vital role in the economy. Your deposit is not just sitting idle, it is actively working to support businesses, create jobs, and drive economic progress. The money multiplier effect is a testament to the power of banking and the critical role it plays in our everyday lives. By understanding this process, we can better appreciate the impact of our financial decisions and the importance of a well-regulated banking system. The double-edged sword: loans, risk, and economic growth. Loans are the lifeblood of any economy, fueling everything from small businesses to large infrastructure projects. They are the bridge between ambition and achievement, allowing individuals and businesses to access the capital they need to pursue their goals. But like any powerful tool, loans come with inherent risks. For borrowers, taking on debt can be a springboard to prosperity. A small business loan can help an entrepreneur launch a dream venture. A mortgage can allow a family to purchase their first home. However, loans also come with the responsibility of repayment, and failing to meet those obligations can have serious consequences, from damaged credit scores to foreclosure. For banks, lending is a delicate balancing act. On one hand, they need to lend money to generate profits and support economic growth. On the other hand, they must carefully assess the creditworthiness of borrowers to mitigate the risk of default. Too much lending without adequate risk management can lead to financial instability. Too little lending can stifle economic growth. Understanding the delicate interplay between loans, risk, and economic growth is essential for navigating the complexities of our financial system. It's a reminder that with great financial power comes great responsibility, both for the institutions that lend and the individuals and businesses that borrow.